All right, Stephen.
Thanks, Mark. Hey, Bill, can you put together a crypto for dummies guide? Because I think I need the starting point, because what you explained to me the other day, I'm still trying to follow. So it's a tough one. I'm looking forward to learning more about that from really smart people, because I don't get it. So let me see if we can get started here. So this is a highly unusual environment. And really, we haven't seen anything like this in certainly in my lifetime, and I think in most people's on the call. And I think there's 6 things going on at once right now. Critical transformations are going to really change how we think about investing, where the opportunities are, but really also it's going to affect all aspects of our daily lives. And these are the 6: the monetary and fiscal transformation, the geopolitical and political one, the digital one, the social and societal one, the climate, and the education. And I'm going to highlight a couple of these. I'm going to go through all of them. I'm going to focus a little bit more on a couple of them. You know, we talk a lot about the monetary one, and now we have quantitative easing and the debate of when to taper, how much to taper, how we're going to deal with that. You have a very uneven economy with countries running at different speeds, and the different policies create different impacts, particularly around currencies. So this transformation has big implications for some time as we wind down this massive buildup of bank balance sheets from the central banks. And at the same time, we're testing modern monetary theory, which nobody really knows if it works or not, or how it's going to play out, or how we can manage through that. So we're really in a very uncertain phase of the monetary transformation. And then at the same time, you have governments trying to use low interest rates and negative rates to provide both relief and stimulus, but really to start to solve some of the longer term problems. And how are we going to deal with that? So I think they're trying to use monetary policy to address fiscal policy needs. And the fiscal policy needs to have low interest rates to do that. So you're in this kind of box where we're going to have to see how this all plays out. This is one of the key ones. And I've showed you this chart before, but massive amounts of monetary and fiscal stimulus. And this is only through December 2020 of last year. As we look at, that's almost 33% of GDP. And in developed nations, over 50% now when you add this year's initiatives. And just to put it in perspective from the US, and I think this is really helpful to get a look at how GDP's gone, how the deficit's grown, federal debt levels, and public debt. But one of the most interesting numbers for me is the net interest figures. And when you look at this and say, if we were looking right now at $345 billion of net interest costs, but if we were to use the interest rates of 2005, you would add $500 billion to the interest cost. If you went back to the 2000 levels, you would be adding over $1.3 trillion to interest costs for our debt. So rates are going to be forced to stay low by central banks to deal with this issue, because the debt levels will become unsustainable. And I think the number with the Biden administration's recent plan would by 2031 have the public debt at 117% of GDP. They think that you would get, only for all the stimulus that they're looking to do with the new programs, only an increase in the interest cost of $31 billion, which would mean that they're projecting that rates are going to have to stay low. That's going to put a lot of pressure on. The challenge is if they're wrong and interest rates start to move up quite a bit, what does that mean for a lot of the plans that the US has, and take that forward to a lot of the other nations that are out there using this unusual stimulus and untested monetary theory. So something to keep an eye on. These numbers are pretty fascinating when you think about our gross domestic product's grown from just under 10 to 22 trillion. The federal debt's gone from 5 to 26, almost 27 trillion, and that's through end of last year and likely to rise again this year. These numbers can be pretty scary if we lose control of interest rates, and if the bond vigilantes somehow get the upper hand and start to force rates up. It's going to put a lot of strains on a lot of the plans that have been put out there, both by the monetary authorities and also by fiscal policy. And you can see, I've shown this chart before, but this shows again net interest costs rising and the big cause of the issues around the debt. This is from the CBO. So they have not come out on the proposals from the Biden administration yet, but those numbers would likely rise if all things being equal, in part because some of the tax issues will sunset from the Trump that would change the dynamics. And so there's a lot of moving parts here that we're going to have to keep an eye on. From a geopolitical perspective, the US withdrawal from global leadership, and now you have China's desire to have at least equal standing, if not greater standing in the global community. President Xi, I think, would take that a step further and want China to be the global leader without question. So you have these shifts going on there, and now Europe's trying to sort out how do they play these shifting geopolitical winds, and how do you protect your own economy and your own population's well-being and still have a major seat at the table. And ironically, if you roll up the EU, it has the largest GDP of any of the between the US, China, and Europe. Europe combined has the largest GDP, but they aren't working from a position of strength, in large part because the internal workings inside the EU and the unevenness and the inequalities of the European Union and how that's playing out. So now you have, add to that, the shifting issues in the Middle East with the partnerships between countries leaning more towards Israel, away from Iran, and how does that play out? And all this is being done against a backdrop where there's a fight for global tech supremacy, which we'll get to later with the digital transformation. And then politically, the populations want so much more from their governments than I believe the governments are able to deliver, and both financially and just politically to get the things done to appease the people with key issues. And these are important issues that take a lot of money and a lot of time. Inequality, immigration, and education have come to the fore, and they are divisive issues that need a lot of support, and that will require a major shift, which we've already seen underway, going from the mindset from governments into from austerity to deficit spending. And these pendulums swing very wide, and if those swings get too great, you overdo it on both sides, but you don't get the full benefits of either one of them. And I think that's one of the challenges we're faced with. Every time something doesn't work for a short period of time, we switch to something else, and you don't get the benefits of either. And add to that, that's coming against a backdrop where people are protesting at a much higher rate. There's a lot of social unrest, which are pushing politicians to do things that they wouldn't normally have done before. And it's changing party dynamics in big ways all over the world. And I think that's going to play out in a pretty important area. And now you're starting to see globally, we have underinvested in infrastructure for a long time. The global price tag I saw a couple of years ago was $57 trillion. About 70% of global GDP is what we need to spend to get our infrastructure to a state of good repair. So there are a lot of needs there. And the other big issue is this carve out of the middle class that's been going on for some time. And all these things are happening against terrible demographic issues. So this is fascinating. This is, to me, the story of governments putting their head in the sand when they know their issues, and then they neglect issues for too long, and the bill just grows and grows and grows. And you're looking at the cost to improve the US infrastructure to a state of good repair has grown from 2001 of 1.3 trillion to now $5.9 trillion, with a funding gap of over $2.6 trillion. So big needs to spend. We've seen these are important areas: drinking water issues, bridges collapsing, how we're dealing with waste, the dams, the whole issue. It's a mess for the US. And the fact that we moved up from this time to a C- average is not exactly a stellar record for the US government to do. States are going to have to take on more of this and are doing more, but the money has got to come from somewhere. And this is a big issue. And that, to me, is a big element in keeping rates low. And then we get to my favorite part, which is the digital transformation. And we've had the view at ARS that productivity is the antidote to inflation. Innovation and productivity are going to be the key to solving a lot of the problems that we have, but they can't solve them all. And it is going to require public-private partnerships to get it done. It's having impacts on everything we're doing. But one of the things that we think is understated or misunderstood in how to play your investment strategy is these rapid advancements are creating new products, new markets, and new ways of solving big issues. But you're getting big new total addressable markets that are creating opportunities that didn't exist before. And we think that's going to be one of the big drivers for how we move forward. And just to take a look at why this is so important, this just shows from 05 to 18, the total economy grew on average at 1.7%, but the digital economy growing over 3 times that rate. And that was before the pandemic. And the jump since the pandemic, we've now seen US digital economy as a share of total GDP at 10% now, and we expect it to continue to rise. And look at these growth rates against the overall economy, not even close in what it's doing relative to the rest of the economy. This is going to be critical for where investment opportunities are, but how businesses are going to have to operate and how governments are going to have to adapt. And then we get to the societal and social changes. And I think the big one, and this is part of the conversation about Bitcoin, is government's role is impacting many aspects of our lives, and it's getting more involved and in some cases too intrusive for many. And that's shifting where people are putting their priorities and where the emphasis is. And it is now time for governments to face up to some of the important social issues that they've neglected for too long. But it's creating a big disconnect of the wants and needs and the ability to deliver. And I think this is going to continue to be a big issue. And then the other big one that's going to be at play, and it's going to impact investment, I think, is this shareholder versus stakeholder capitalism move. And how do you balance the two out in an effective way that allows the appropriate flow of funds to the areas of need? Because we forget that capitalism is a funding source for a lot of the needs that we have as an economy. And that's going to be an important element to not go too far, swing the pendulum away from delivering on what capitalism has done such a good job of for so long. While, I have to acknowledge the flaws in it, it is one of the better systems in the world. And as Churchill said, you get an unequal sharing of the benefits in capitalism versus socialism with an unequal sharing of the miseries. That may be taking it a little too far, but the concept, I think, is one that we shouldn't lose sight of. When you get to the social areas, I think the views that we're seeing of what the pandemic's done to change how we live, work, and govern should not be understated. This is a transformation that I think is going to take some time to play out, and there'll be a lot of missteps along the way for corporations and businesses, as well as the governments. But we're going to have to do this in a way that we're dealing with a backdrop of significant social unrest and discontent. And we're going to have to see how that plays out. And then the big one, which is getting a lot of press, is the more and more as we go through, is the climate transformation. And how do we get to where we need to get to? And whether it's the permafrost, wildfires, water temperatures, what you saw in the last couple of weeks with Exxon having activists win a seat, Chevron under pressure, the Royal Dutch Shell ruling could be a watershed issue. And I'm not as expert on that, but I know Eddie and some of the others on the call can really get into that in more detail. But this is going to change the responsibilities of corporations in a significant way. And then you have the ESG momentum, which is going to shift where capital flows and how it flows. So I think these are all critical issues, and there are big opportunities to make the world a better place if we do it right. But you can't do a transition without having a thoughtful plan for it and a progression that works all around. And quite frankly, you can't do it without China playing a much more cooperative role because they can control, they're one of the biggest polluters and they have one of the biggest issues. And if they're not on board, where does that leave us? I think this water temperature chart is fascinating. to just look at where the average was and where we are now. And this helps explain a lot of the violent storms that we've had, the increase in hurricanes, and the damage that we've seen to levees and cities in the southeast of the United States. I think this is an issue that we can't ignore. I'm very passionate about the ocean. I'm a advanced scuba diver, and that's one of my getaways. So this rising water temperature is a big concern, and what it's doing to the migration patterns and the fish life is something that we have to really pay attention to. It's a big food source. And then you have the educational transformation, which is really the skills gap issue. And I think this quote is really telling, and we forget this about the hope of a nation lies in the proper education of our youth. We have to do a much better job in the US and in other countries in how we do it. But I think the US is one that we've really lost our way in many areas, and we need to rethink early education. We have to prepare students better for the fourth industrial revolution, but we also have to think more about the types of skills and jobs that are out there that you don't need college for, that we had this big push that everyone should graduate college. I think that was similar to the push that everyone should own a home. And as we saw from the financial crisis, that is not necessarily the case. But we need to really think about apprenticeship programs and also how we deal with the pandemic fallout, particularly its effect on women and minorities and the less educated in the system. We have to step up and do much more in this area. So our area of focus at ARS right now continues to be on the tech revolution, the digital transformation, and how it plays out through all these areas. We're also very focused on industrial and material investments. We think that these supply chain shortages, some will be short-lived as we work through and meet the initial supply shortfalls. But then in certain areas, we're going to have longer-term issues, whether it's the steel industry, whether it's copper and some of those other areas. We think they'll come down in price, but there will be continued need and support for higher levels of production than we had in the past. We think the healthcare area continues to be one of the key areas of breakthroughs. And McKinsey had an interesting report recently where they showed that the path for getting a drug approved in the past was a 10-year cycle. We've been able to break that down through the pandemic to a 1-year cycle. And people are a little skeptical about the vaccines that didn't go through that long period. But if you think back, even when we had the 10 years, they weren't able to analyze the data the way we can analyze data today, which gives you a higher quality of the research behind the vaccines and drugs that we're coming out with. We think technology is going to play a major role in this area, and they're going to continue to build up pipelines and provide a big dividend for society there. We like stocks that will continue to grow their dividends. We think the low interest rate environment will persist, and with high quality companies, you can get a 70 to 100 basis point pickup in yield without taking on exceptional risk. We think business models are going through massive changes right now, and M&A activity will pick up, where companies will be hiving off lower return businesses and replacing them with tuck-ins that actually solidify their positions or bring new technologies or enable new markets. So those are the key themes. And then the company characteristics. There are companies that have embedded advantages that you want to focus on, that they're able to make investments and grow their business and be protecting their future while creating a differentiation from their peers. And you're seeing that in a lot of areas, particularly in the big tech areas. So Mark, I'm going to stop here and open up to questions, because you have a fabulous session coming up, and I think people would want to get to the cannabis one soon. So
You always say that, Stephen.
well, the macro versus cannabis is not a fair fight.
Stephen, that was great. Can you go back to that spreadsheet style chart that shows the interest rates, and kind of just go back to your script and repeat that again, because I need to catch that, and I think that is like so important in terms of growth of the potential interest burden.
Yeah, give me one sec here.
And Bill, if I can tag along on that, I had the same kind of thought. I guess just really one additional question, Stephen, can we really keep interest rates low forever? I mean, is that even like really plausible here? I mean,
Well, forever, no, Joe, but look at Japan. You know, they're on a 30-year run. It's not helped their economy much. So let me say that's not a good thing, but rates can stay low for longer than people would like.
Stephen, just to add on to piggyback on those two, is there a inflection point, or threshold level of the interest rate as it rises in the future, where then it becomes the debt becomes unsustainable, especially relative to whatever assumptions you have for economic growth rates?
Yeah, there is. I haven't worked on that one yet because there absolutely is. There's a number that one, people will not feel confident buying the debt. So that's the first issue that you got to focus on. But I think the issue here, Bill, let me just kind of walk through this again slowly. So first column is the GDP, and you've seen we've slightly doubled in the 20-year period, but the deficit's risen to $3 trillion. It's projected to probably stay around there this year, and then in 2022, the Biden administration suggesting it's going to drop to $1.8 trillion. I think there's a lot of hope in those numbers. So I think that's an area to focus on. The federal debt and the debt held by public, massive increases. And Sean Lullis did the math for me yesterday on this. I think it's something like a 350% increase in the debt, and you know, a much lower number for 50% increase for the interest. But I think these numbers are really something everyone should keep an eye on. This is a report that you can go online and get. It's the Economic Indicators report from the Council of Economic Advisors. And what you see here is this massive ramp up in debt, running away from the financial crisis, where we had to force rates down and keep them down. And the only way we can do funding for a lot of the initiatives and needs that we have globally is for rates around the globe to stay low. But you have to have willing buyers. And I think that's going to be the key issue as we go forward. So if the 340, I'm sorry, if the current debt levels went back to 2005 numbers, you would add in interest rate levels, you would add 500 billion to debt. If they went back to the 2000 Fed funds rate, you would add $1.3 trillion to the interest cost. And
it becomes unsustainable then.
Yeah, 6% would be a problem.
But I mean, I guess my question is, as an economist by training, but not a practitioner like yourself, there are a couple of variables here, okay? Economic growth rate, how much the deficit and debt is increasing, and the interest rate. Those are the three, in my mind, the three big variables. We have made assumptions for the deficit and the debt going forward. We can make projections, CB or whatever projections you want to take on the economic growth rate going forward. Let's say 3%. But the interest rate is, I think, the unknown and the most dangerous variable. Because if that increases to, I don't know what the number is, but it's in some ways it's math. If it increases to 3%, then the interest burden becomes unsustainable, and it spirals out of control. If it's under a threshold number, it can be contained if economic growth rates are greater than the interest rate. So very simplistically, if the economy and the total amount of debt is the same, which there approximately are now, let's say 20 trillion. If the economic growth rate at 3% is always greater than the interest rate, you can grow your way out of this. The minute the interest rate is greater than the economic growth rate, assuming the same debt and economic and GDP levels, it spirals out of control. It's just math. So any sense on what that number is based on assumptions you're making on the growth rate, the economic growth rate, as well as the debt growth rate?
We don't try and figure out at our firm, we're not trying to figure out the beyond a couple of years because it's not worth us spending our time on. For us to invest, we're trying to invest in the next 24 to 36 month period. And in that period, we don't see rates rising enough for this to be a problem. But I do think there is you summed it up very well. If your GDP is growing at a higher rate than the increase in your debt servicing, you can manage your debt burdens. The problem with that is you need people to continue to buy your debts as you're refinancing the debt. And the bond vigilantes who have risen in the past have been pretty quiet lately, but when they start to take hold, if they have no confidence in the ability to deliver on the ability to cover your debt costs, then you'll see rates be forced to move up to get people to continue to buy your debt, and then it becomes a problem. So you have to see a GDP growth that's been higher, which means you have to have greater productivity. And I think for countries like the US, this also means that you have to have your immigration policy right so you can get your population up
Labor force,
and your
yeah.
productivity up
Yep.
to work.
Got it. Thanks.
Bill, I hope I answered that for you.
Stephen, may I ask a question here? The United States is unique in that this is the global currency. What role does that play in allowing us to grow our GDP or to grow, I'm sorry, to grow the deficits that we continue to grow? What's the relationship?
Yeah. The dollar's reserve currency is a key element for the U.S. in being able to manage our debts well and being able to get away with things that some of the other countries would not be able to get away with. Is I think the best way to say it. Not the most appropriate way, but probably the most accurate way. And if we aren't the reserve currency, that has a whole other slew of issues, but it will put greater strains and make our debt problems look like a lot of other countries' debt problems.
Isn't that, Stephen, isn't that what proponents of MMT, that's the magic the proponents of MMT rely on?
Yes, and they rely on the fact that the bond vigilantes won't win, and that you can just print your way to it. And I think there is an element that they're right up into a point, but all these policies are only right up into a point. And there is a level that, and somebody can do the math to figure it out. I haven't done it. That would tell you that you can't keep doing what you're doing. I think we are, for the Biden proposal, just so we can kind of jump to that a little bit. When they talk about 20, the level percent of that to GDP, it really is a 3.5% increase to the current budget proposal. So I think we're at 22.5 going to 25 if the Biden budget went through. So a lot of this gets distorted, but I think you have to be careful at the levels we're getting to. I think it is a theory. And what did Yogi Berra say? That in theory, there's no difference between theory and practice, but in practice there is. And I think what you're going to find is modern monetary theory only works to a certain level. You can't do it without restraint.
Stephen, this is Lux. If I can ask a question, I have a couple of, I know we are short on time. So you mentioned about the debt, and you also mentioned about the US currency. In terms of debt, we are sitting over like nearly 27 trillion. To put it in words, it's around 133% of the GDP. And Japan is at 257. So you talked about like we can keep the interest rate at zero for as long as we can. But realistically, considering you're only projecting for the next 36 months or so, how long we can keep the interest rate zero? Is there any shift in terms of analysis post-pandemic, or like?
Yeah, let me clarify something. I don't think we should do what Japan's doing. And I think we have a different economy, so I don't think we'll be stuck in a 30-year cycle like they've been. I think we have a more dynamic economy, just to be blunt about it. But I think that we can't keep rates at zero, and we shouldn't keep rates at zero. We should move them up at the appropriate time, and it may be too soon right now, but we first have to taper the quantitative easing that we're doing before we raise rates, because it doesn't make sense to do it any other way. And I think the Fed will start to talk about tapering, and then eventually they're going to have to, probably ahead of their schedule, which I think is end of 2023, they're going to have to move to raise rates prior. But increasing rates is a sign of a healthy economy, not a bad economy.
Yeah.
It's just a question of getting to a level of that's appropriate for the growth rate and where our economic needs are. But we can't do it with the policies that some of the policies we have now. And one of the big ones is immigration. For all the talk about immigration, our immigration policy is fundamentally flawed in so many ways. I'll give you one example. Our friends to the north let in about 300 to 400,000 skilled immigrants into their country a year. We have a program, which is the H-1B visa program, which we let in about 85,000 people a year, but we have over 200,000 people apply. They then are educated here, end up going back to compete with our country with dollars from foreign corporations to the US, that foreign dollars held overseas. And then we import stuff back into import inflation back. It's a fundamentally flawed system. That if we kept the skilled labor here, skilled people here, they're going to pay taxes, help grow our economy, create innovation, create new jobs, and create new businesses. That's the way we should be going. So it's all together. So sorry, Mark.
No, I mean, I could stay here for hours. And the great thing is I get to be with you for 3 straight days. As I think about it,
I'll get thrown out of the car if we keep talking about this.